comes something which is a repurchase. I want you guys to be very careful about this. Okay. What is a repurchase agreement? See, general rule, what happens is, and I'll tell you what is the approach. When you draw a mental model for understanding whether a particular item or particular situation is a lease or a financing arrangement, we will have to go and dig a little deep. Now, see, every time there's an arrangement to buy and then repurchase subsequently the same item between the same parties. Actually, if you look at the substance over form, it is not a buy sell agreement. It is something else, right? So, in a typical situation, an asset will be sold by A to B, and then A would be repurchasing the same asset from B, right? So, when you go to leases, you will see that there's something called sale leaseback transactions, okay? Now, we will have to look into the substance of the case to see, is it something else which is disguised as a purchase and a sale agreement? Or is it actually a sell and a repurchase agreement? Because if you look at the general rule, it is highly unlikely that two parties will get into a contract to sell and then to repurchase the same asset again. Okay, it defeats the human logic of selling and the rationale behind selling if you want to repurchase it. So, in most cases, you will see that repurchase agreement is bundled into three situations. The first situation is something called a forward option. What is a forward option? I am selling it to you, and there is an obligation or that I will repurchase it back to you, back from you. That means I have to sell. So it's one agreement, and the sale agreement and the repurchase agreement goes hand in hand. You cannot segregate the two. So A will sign two contracts with B, which will be bundled into one, where there will be a date for the current sale and the date for the future repurchase. And A does not have the option, or B does not have the option to avoid the two contracts. The second happens, which is called a call option. What is a call option? Call option and put option is when you go to derivatives, which is there in in bar exam, which we'll be doing after FAR. You will see that a call option is an option to purchase. So in this case, A would have a right to repurchase the asset. If A wants, A would go and repurchase the asset. And if A wants to do it, then B cannot say no. And the put option is an option which is an option where the other party is the dictator. In other words, the other party, if the other party wants A to repurchase the asset, then A cannot say no to that. So typically, a forward is when both the parties are obligated. A call is when you take a call whether you want to repurchase or not. So if the situation is favorable to you, you will repurchase. If no, you will not. And the other party, which is B, will not be in a position to force you to repurchase. And a put option is when the advantage goes to B. B will say if you want, we go for it. So if B wants you to repurchase, you cannot come out of it. So if the transaction of the repurchase is favorable to B, then A has to oblige. So there can be three situations where two parties can get into a situation or get into an agreement where you would sell and they would subsequently repurchase the same asset. Now, in the first two cases, where you are the person who's calling the shot and you are the person who are obligated. So basically, once it is binding or once it is optional for you to repurchase and you exercise that option. In both the situations, what matters is what is the repurchase price in comparison to the selling price. Now, my suggestion to all of you is to think in terms of cash in versus cash out. Okay? Now go slow and tell me if my repurchase price is lower than my original selling price. So if I'm repurchasing, it is lower than my original selling price. Then what is it going to be like? Is it a cash in net or a cash out net? Guys, is it a cash in net or a cash out net? If my repurchase price is lower than my original surplus price. So repurchase is cash out. So my cash out is actually lower than my cash in. That means you are getting more. Can you understand this? That means you are getting more, right? That means you are getting more. When can you get more? When you are selling an asset to somebody and then when you are repurchasing it and that person is giving you a lower money, right? You have to shell in a lower money. That means that person is occupying and what he is giving you is in excess. Why? Because he's used. So basically, let's say if it's a 3 months arrangement and I get into a sell and a repurchase agreement. So essentially, it is a lease contract, isn't it, guys? Can you think about it? If I if you pay me more, so simply what you're doing is we are getting into an arrangement which is a sale and a lease, sale and a repurchase. So basically, it's sale and repurchase agreement. And for 3 months, you're paying me more. It's typically that I'm allowing you to use my property for 3 months, and that extra inflow that you're giving me is because of lease. Yes or no, guys? Makes sense? So my suggestion is always think in terms of cash in versus cash out. So now tell me what happens if the repurchase price is more. That means I am paying you more. I'm buying, so basically the asset is with me. I am paying you more for 3 months. What can it be? Can anybody tell me? What does this look to be? What does this look to be, guys? I am selling my asset and I'm buying it back. So basically, I am retaining the right to the asset and I am giving you more. I am giving you more. So for 3 months' time, I am giving you more. Why will I give you more? Can anybody think and tell me what kind of a transaction can this be? Let's say, uh, let's say Ketan and Money, they get into a transaction. Ketan has a property. Ketan gives the property papers to Money. And then in 3 years, in 3 months' time, ultimately Ketan ends up giving $10,000 extra to Money. What is actually happening, guys? So remember what is happening when the original selling price is less and I pay you more, right? So basically, you pay me $50,000, I use it for 3 months, and then I pay you $60,000. And you have my property papers. What is this actually? It's easy, right? Think, what is it? Is it not a financing arrangement? It's just a financing arrangement. The sale and the purchase back is I need money. I go to you. You say I need the property papers. And you say, okay, let us get into a sale and a repurchase agreement because that is how I'm going to show this in my accounting records. So what you do, you say, okay. So you make the sale and you've paid this guy $50,000. And then after 3 months, this guy again repurchases that property and he pays you 60,000. So it is actually a financing arrangement where the property acted as a collateral. That's it. It is actually because the cash out, so repurchase is cash out, right? You are paying more than the cash in. So it's actually a net outflow from your side. Why would you pay more? Because you wanted that $50,000 desperately, and the other party was not ready to give it to you just on your face value. So that party wanted something else. So you gave the property as a collateral. Now the property is yours and you've paid that person an interest, which is 10,000 in the next 3 months. So every time when there is a sale and a repurchase, you need to ask yourself, is it a net cash in or a net cash out? If it's a net cash in, that means the other party was in a position to use your asset and paid you lease rentals. If there's a net cash out, that means the other party gave you money and you paid back the money with interest, and the balance was that interest was because of the financing arrangement. What happens if it's a put option where the other party is requesting you? Now, see, general rule, the other party will only force you to exercise it when the other party will get more. Obviously, right? Because when the other party is at the receiving end, where there's a losing end, the other party will never force you because now the option is at the other party. So the only scenario possible is when the other party would receive more from you. Okay? So when the original selling price is more, in that case, the other party receives. Uh, so it is in this case, you're obligated to repurchase the asset, the customer's request. And the only thing that can happen is either lease when there's an economic benefit, or it will be a sale with a right to return in case if it's a put option. Or it will be a sale with a right to return if it's a put option, if there's no economic benefit. So what I'll do is I'll give you a question from here. See, it's the same situation, right? When your repurchase price is lower than your original selling price, and if there's an economic incentive, then it's a lease. If there does not exist an economic incentive, then it's actually a sale with a right to return. Okay, let me just show this to you. The first question, okay, guys? On Jan 1, year 1 second. See, on Jan 1, year 1, A enters into a contract with T company for the sale of machine for $300,000. So here we have A, here we have T. A is the seller, T is the buyer. What is the amount? The amount is $300,000. The contract includes a call option that gives A the right to repurchase the machine for $350,000. $350,000. So this is the original selling price. And this is the repurchase price. On or before 31st December year 1, T pays the entity $300,000 on Jan 1 year 1. On December 31st year 1, the option lapses unexercised. This guy did not exercise the option. How would you account for the transactions for this on Jan 1 and on December 31st? Is this clear? So basically, when the contract was made on the 1st of January, there was a contract for 300 plus, which is sale. And then at the same time, it was written that if A wanted, A would repurchase the machine at 350. But A did not exercise the option. And the end of the year, the option lapsed. Okay. So what could this have been? Can you tell me, guys? What could this have been? See, here the repurchase price is more than the original selling price. Obviously. So basically, I'll get less and then I'll pay you more. So this is typically a financing arrangement. This is typically a financing arrangement. When can you recognize the revenue, guys? Because in this case, the option did not exercise, right? The option was not exercised. So when can you recognize the revenue? Now see, on 1st of January year 1, I got the money because the machine was sold. I got the money for how much? For $300,000. But I can't book it as a sale because this is not a sale, because this is a sale which is purchased with a buyback. So what do? You have a financial agreement. So it's typically like a liability. How much? $300,000. So on 1st of January, you will not book the sales in your book because you do not have an unconditional right to sell that property. You are still retaining the right to repurchase it, right? The first condition for a sale is it has to be a unequivocal sale. The rights have to be completely transferred. But here you have not transferred the rights completely because you are retaining an option to buy back the machine at an increased value. If you repurchase, you know that you'll have to pay more. That means then it will be disguised as a financing arrangement. So what you're going to do? On or before, T pays the entity $300,000 on January 1 and on 31st, the option lapses unexercised. So what you do? On 31st, when you have not exercised the option, then what you're going to do, now you're going to book sale in your books. See, it is up to you. If you want 31st December, you can do two things. First, you can accrue the interest liability. So if you want, you can do this. You can do interest and then you can create a credit for the financial liability, whatever, financial liability. How much? 50,000. You thought you're going to exercise it. So what you do, you kept on building on it. You built it. But at the end of the year, this guy lapsed. So you did not want to go and repurchase. So in that case, now you have to recognize the revenue. So on 31st of December, year 1, one thing is very clear that I'm going to book. Okay, 1 second. Let me see if I can. Okay, no. So one thing is very clear that now I'll have to book revenue. I'm rubbing this here. So how much is the revenue that I'm going to book here? On 31st of December, the revenue that I'm going to book is two sales. How much? I cannot book more than $300,000. I know I have to negate the financial liability that I have put in my books, which is now snowballed to $350,000. And the interest that I had thought I would incur, I'm not going to incur it anymore. So that is going to be credited. Is this clear? What we're trying to say is if it's a sale and a lease back arrangement, even though the actual legal form, if you go, it is showing that there's a sale, there's a paper for sale. But if there is a buyback arrangement, then under no circumstances the sale final. So you cannot book revenue in your books on the first day of the year. You can book revenue only when there's an unequivocal transfer of ownership right from you to the buyer. When is that happening? That is happening only when the option is lapsing. So when you're booking it at that point of time itself, you need to understand whether there is an in versus an out. Whichever, if there's a net in, that means you're getting more. Somebody's paying you more, then it's a lease liability. Then it's a lease income. If you are paying more, then it's a financial liability. So in this case, when you get the money, you don't book it as a sale, you book it as a liability payable. And then you accrue the interest, but when the option lapses, you're simply going to reverse the liability, write off all the expenses that you thought you would be incurring, and now you will book the sales revenue for $300,000. Is it okay to everybody? So these are a little dicey questions and you might get confused a bit. So train your mind to think slow and in the process. First, in all of this data, see 10 to 1 when you look at a question from revenue recognition, you will be able to understand what type of question is it. Okay. So you'll have to go slow, try to figure out, oh, this is sale and lease back. Okay, then what's the rule? The rule is find out whether it's a repurchase price versus original selling price. If the net in is a net in, then it's a lease income. If it's a net out, then it's a financial liability. But if it's a put option, I know that the financial liability cannot happen. It can only be lease, but that also if there's an economic incentive. Otherwise, it will simply be a sale with a right to return. So I'll tell you what it is. Let's go to the next question where we have a put option. On Jan 1, year 1, A enters into a contract with T for the sale of a machinery for 350. So now we have A, we have T. A is the seller, T is the buyer. The machine would be sold. So there is a dollar inflow that would come to T of $350,000. So this is the original selling price. The contract includes a put option that obliges A to repurchase the machine at T's request. So if there's a repurchase, that means the money will now go from A to T of $315,000. Can you understand what's happening? So the only reason why it will happen is this, right? That so again, this might sound a little strange because you'll say, why will T get into something like this where T will have to pay more? T will have to pay more, but there would be a repurchase provided. Now, another value is missing here, actually, guys. I think this question would have come in everybody's mind. Why is it that T would force A to repurchase it? If T is in a situation like this, why will that only be a one-sided lease arrangement? Go to the next data that is missing here. See, on or before 31st of December. So I sell a machine to you, and when I sell it to you, I get 350. But then I also sign a contract which says that if T would want, I would be forced to repurchase the machine from T at 315,000 at the end of December. The market value is expected. Now you are expecting, if T is expecting the price of that machine to fall down to $275,000. Okay, T is expecting. So now let's see if the market value falls down, and then if T will force A to buy back that machine, then there is an economic incentive for T to force A to buy back that machine, isn't it? In that case, it will become a lease contract. In that case, it will become a lease contract. See, the market value is expected to be 275 on 31st of December. T pays A $350,000 on Jan 1. Determine whether A should account for this transaction as a lease, as a financing arrangement, or as a sale with a right to return. See, first of all, it's a net cash in. So it has to be lease. But lease only if T, see, it's a put option, right? If it's a put option, that means T is forcing you to do it. It is not at the behest of A. So if T is forcing, T will force only in two situations. When T is genuinely making a profit out of this force transaction. If T is making a profit out of this force transaction, that can happen only if the day when the repurchase would have to be exercised, the fair value would be lower than what the exercise price is. So if it is lower, then we know that T has an economic incentive for forcing A to buy back the property from T. In this situation, the transaction is a lease arrangement. It's a leasing arrangement. See, nobody can force you to take a loan. Remember that. So if I am asking you to repurchase, I need to have the property in my hand. That means when you sell that property to me, that property is now mine. Now, if I'm forcing you to repurchase that property from me, in that case, there has to be economic incentive. If it isn't, then I know that it's just a sale with the right to return. That means I have already sold tea. Now, when tea is forcing me to buy back, market price is also 315, and I'm also paying tea 350. Now, in that case, the only reason is that T did not want to retain the property. T wanted to just experience that property and feel, and T was ready to pay you a rental for using it for 3 months. Are you understanding the situation here, guys? See, let's say I have a lake facing property, but it's a secluded property, and I'm wanting to sell that property. A buyer comes in and says that, see, I have lived in the city life all my life. I'm not too sure whether I will enjoy this. So I will have to experiment it for 3 months. I'm interested in your property, but I really don't know. Certain things are unknown to me right now. So we get into a sale and a leaseback arrangement. Said, okay, for the time being, I'll execute a sale, but I'll give you the right that if you want me to repurchase it from you, I will go ahead and I will do it. Now, if T is genuinely only looking for this and T says, okay, then whatever is the fair market value of the property after 3 months, at that price, you repurchase the property back from me in case if I'm genuinely not in a position to enjoy here. So what happens? Basically, she is paying me. So what we do is the paperwork is set in such a way that whatever would be the rental that he would genuinely be expecting to receive for renting out that property for 3 months, I'm going to build it into the sale and repurchase agreement. So what would happen? He would sell that property at 350. And only after 3 months, when T decides whether he want to remain and whether so if he decides, no, I'm going to enjoy that property and he's going to stay there, then 350 is a sale after 3 months. So it's a sale with the right to return if the repurchase is happening at the fair market value. But if the repurchase is happening at a state where T is getting a benefit, in that case, then it's a leasing arrangement. Is this clear? Because T has actually contracted. The reason T has got into all of this is because T is effectually dug out a good deal for that during this 3 months period. Okay, so repurchase agreement is a little tricky. Figure out that if it's a sale and a buyback, it can be either when your repurchase price is lower, that means your cash out is lower, that means your net cash in is higher, that's a leasing arrangement. If your repurchase price is more, then it's a financing arrangement. For a put option, it's either leasing if there is an economic incentive. When is there an economic incentive? When T is forcing you to buy back, T is making a money as a fraction of profit out of it. Then it's a leasing arrangement. Else, it's a normal sale with a right to return.